Hey guys, welcome to the new series of option trading strategies. The first strategy we are going to cover is buying call options, or in other words, we call this naked buying call options. So what is this strategy? It is really important to understand what does this strategy do, and this strategy, I would say, is the strategy which could wipe out your whole capital over a period of time, and you need to be aware of that. And as retail traders, these are the strategies which we prefer, like buying call option or buying put option. So buying naked options is the strategies which retail traders do love, but they kind of make a mistake in choosing this strategy, because there are some rules which should be there when you deploy the strategy, and we will cover those rules in the strategy. If you deploy these strategies with those rules in your mind, then there is a likely chance that your probability of making a profit could be higher. But yeah, this is one of those strategies where the probability of making a profit overall is lower. So let's go and look at the rules and what are the steps that we should look at before deploying this strategy. So the rule number one is that you should have a view on the market. Okay, so what kind of views can you have on the market? You can have a bullish view, you can have a sideways view, or you can have a bearish view. This strategy, your view has to be bullish. Your trend has to be bullish. And you can't be having a trend which is sideways or sideways to bullish. This strategy, you need a trend which is super bullish. So if by any chance you don't see a trend which is very bullish, then I would say this is one of those strategies which you shouldn't consider. So rule number one is you should have a proper view on the market, and the view for this strategy is bullish. Correct? So this is the step number one which we have to consider. What is our view? We have to be bullish. The trend needs to be bullish. And all these strategies in this series, I will be teaching you on Nifty 50. And in no way, these strategies, whatever I'm teaching you, are a recommendation that this is how you should trade in these strategies right now. I'm just taking examples, and in no way I'm telling you that you should deploy these strategies, because the market might not be the best for these kind of strategies, which we will discuss slowly in this series. So now we've made a view on the market, and our view is that the market is bullish. Okay, so now what's the second step? And the second step is we have to choose the expiry. So the rule which we have for choosing the expiry is that we have to at least take 2 to 3 weeks ahead expiry. What retail traders tend to do are that they take expiries which are the closest one, like 2 to 3 days away. Firstly, you're not giving time for your view to work out. Secondly, time is not your friend when you are buying call option. When you're buying call option, time is not your friend. So time is not your friend, and I will teach you why time is not your friend when we go ahead in this video. So for that reason, watch the video till the end. And time is not your friend. For that reason, I would say that you should take 2 to 3 weeks ahead expiry. If you can take a further away expiry, but don't make the mistake of choosing the closest expiry, because that's what retail traders do, because the premiums on the closest ones are lower than the 2-3 weeks further away expiry, and premiums are lower, so you have to give lower margin, and retail traders think that, oh, the premium are cheaper, we would buy this strategy and we would make a higher profit. But they are cheap for a reason, because they will end up being cheap over time. So the premiums won't rise, and the probability of you making a loss will be higher. So the first strategy and the first rule on this strategy is the expiry. So let's go and let's deploy the strategy. So first we will choose the expiry. So currently we are at 23rd March. The closest expiry currently is 23rd March. Now we will go and look at 2 to 3 weeks away expiry. So next expiry is at 23rd, after that 29th. So let's take 6th April. We will have about 14 days for this view to work out, and for this strategy to be there for us. And the option contracts won't expire till the 6th April expiry. So now let's see what can be done after this. So the second thing which we have to note is choosing the strike. So how do you choose the strike? So strike has Greeks, and I deploy my strategies through Greeks. So the rule number 2 for me is the delta of these strategies should be higher than 0.55. So the call option strike which I choose should be higher than 0.55. And why do I say that? Let's go and let me explain that to you. So if you see, if I go to Greeks and if I look at the Greeks, so at the money option, Greeks are close to 0.50. So right now the price of Nifty is around 17,167. So at the money delta is equal to 0.5. So 0.5 is this, and that is strike 17,200. So 17,200 is at the money option, and which are out of the money options, they will be higher than 17,200. So higher than 17,200 are out of the money options, and lower than 7,200 are in the money options. And when you are deploying this strategy, you have to only deploy in the money options. What retail traders make a mistake is that they take out of the money options, and the reason for that I will tell you is that the premiums on these options, on out of the money options, are lower. And then what retail traders end up doing is that they get a lower premium, so they think that we have to pay lower margin, so let's take out of the money, but they tend to remain cheap, as I have told you, and then they remain out of the money for a longer period of time, and then you end up losing money. So for that reason, we will take in the money options. Yes, you will have to pay a higher premium, but the probability of you making a profit will be higher. So second option which we've just said is we need to take delta should be higher than 0.55. The strike should be that. So let's go and let's look at the deltas. So the delta of 0.53, 17,150 strike is 0.53. We won't choose that. Then delta of 17,100 is 0.57. So we will choose the 17,100 strike. So we are going to choose 17,100. So let's go and let's click the 17,100 and let's buy that. So now we've got a payoff chart for us. So the rule for strike is that we have to choose in the money options, and we can't choose out of the money options when we are doing naked buy call option strategy. So if you're just buying options, never, like even if you're buying put options, never choose out of the money options, choose in the money options, because the probability of you making money is higher. So now let's understand the payoff diagram of this strategy. So we've deployed till now, we've understood the expiry which we've chosen is 6th April. The strike which we've chosen is 17,100, and the price which we are paying for this option is 251. So the premium which I'm talking about is 251. So the premium is 251 to buy this option. So now what is the maximum loss on this strategy and what is the maximum profit? So when you're just buying naked options, so if you're just buying call option here, so your profit will be unlimited. And what retail traders tend to do, and when we are beginning our career in trading, so what we tend to do is we look at this and we're like unlimited profit, and then we tend to go for the strategy. But unlimited doesn't mean that you will get unlimited for sure. That's not there. But yeah, the maximum profit in this strategy is not defined. But on the other hand, your maximum risk, which is the maximum loss that you can make on the strategy, is defined. So whatever option premium you pay, the maximum loss that you can go and have is if these premiums go to zero. And each option contract of Nifty is 50 shares, or one lot is 50. So if you multiply 50 into 251.95, you will get this, and that is your maximum risk. You won't lose more than that. And there are some strategies which I'm going to tell you when we go through this video, that there are some strategies which you can deploy, and the rules which you can deploy, wherein you won't lose that much as well. Now, how do you calculate the break even? So the break even is 17,352. What do you mean by break even? Your net profit and your net loss is equal to zero. So your PNL is zero. But this break even is on expiry day, which is 6th April. It doesn't mean that if the price goes by tomorrow, it goes to 17,300 or 17,350, you won't be making any money. When we say break even, it is on the expiry day, that is 6th April. When this contract expires, you have to be higher than 17,352 on Nifty for you to be profitable. If you're lower than that, then you will be losing on this trade. So your break even on expiry is 17,352, but doesn't mean that before expiry, if the price goes from currently the price is 17,167, and if it goes towards 17,350, you won't make any money. Yes, you will be making profit, and I will show you how you will be doing that, and I will show you the payoff diagram as well. Now, the important part on the strategy is the probability of profit. The probability of profit on buying call option strategies is only 38%. So that's what I was saying, that this is a strategy where the probability of making a profit is lower. But what we tend to look at here is that the margin or the funds needed to deploy this strategy is only 12,500. Whereas on other strategies wherein the probability of making a profit is higher, your funds needed will be also higher. So now let's look at the payoff diagram, which is very interesting in this strategy. And then you will come to know what was I saying, that time is not your friend on this strategy. So what did I tell you? Like, let's take an example that you go to 17,350 in the next 2-3 days. So it doesn't mean that you won't be making any money. So let's take our date as 24th. So that is 2 days after this. So 24th is Friday. And let's take at 2:30 on 24th March, your price is 17,350. So what does that mean? That 17,350 when your price is, so that doesn't mean that you won't be making any profit. What did I tell you? On Friday 24th March, if the price goes to 17,350, you will be making 6,645 rupees. So if the price goes to 17,350 by Friday, you will be making a profit of approximately 6,600. But on expiry, if this same price is there in Nifty 17,350, you will not be making any money. Why is that so? Because time is not your friend in this strategy. As time passes by, the profit on this strategy starts coming lower. So this is a target date and this is our on expiry. So this line which I'm talking about, this line is the expiry profit and this blue one is the target date payoff. So now if we go and now if we increase the date and see what happens. So if it goes to 24, then increase the date, 25th, 27th, 29th. Look how this blue line, which is the target date line, is coming lower. And as you go towards the expiry, that same level, that 17,350 level is going to give you a zero profit. So that is why time is not your friend. And another rule which I'm going to tell you here is you have to exit the trade 3 to 4 days before the contract expires. Don't hold the strategies till expiry. So this is a very important rule that you should consider. Now you tell me that, Uday, you were saying that the maximum loss you will make is not 12,590. So yes, there are some rules which you can keep for these strategies, and I'm going to tell you what those rules are. So let's take an example here. So let's take that on 27th March at 2:30, the price is at 17,100, your strike. So let's take the price is at 17,000. So if it is at 17,000 on that day, your loss will be approximately 5,600. But if you take the expiry date, on expiry date, that same loss will be maximum loss, which is 12,500. So for that reason, I'm saying don't hold these expiries till the expiry date. These contracts shouldn't be held till expiry because you will end up losing money as you get closer to the expiry. So you should exit these strategies 3 to 4 days before the contract is expiring. Now, what can be the strategies for that? We can have two rules. We will mark on our charts, when we are buying, so our view is that Nifty is bullish and it would go up. So if we can't be 100% about our view. So if our view is about to go wrong, then what should be the plan of action? So we will say that 16,800 around is the level wherein there is a support for this price. So if 16,800 breaks on Nifty, you can keep a stop loss there. Or either another way you can keep is your strike is 17,100. If it starts going below 17,100 to 17,05, you book a loss and you take that as a stop loss. So either you mark the support and take that as a stop loss, or either you make a rule that when the option goes from in the money to out of the money, then that is when you exit the trade. And I will show you that how this will help you. So let's take that first rule is that it goes to 16,800, 27th March, it goes to 16,800. What will happen? Still, you're not losing all your money. You're losing 9,278 on 27th March if the price goes to 16,800. And now let's take an example that it goes to 17,050. It goes below your strike price. And that is when you think that I will exit the trade. And at that point, your loss will only be 4,500. So you're still not losing all your money and all your capital if you have a strict stop loss for these strategies. So now we come to the rule. keep stop loss, and that could be either support on chart, or the option goes from in the money to out of the money. So here, when it goes from 17,100 to 17,050, it starts going out of the money, and that's when you can book your trade, and that will also give you a lower loss. So this is another rule which I wanted to discuss with you, that keep a stop loss, and profit you should take before 3 to 4 days, whatever it is. Don't go for unlimited profit. Just whatever profit you're getting, exit the trade 3 to 4 days before the contract expires. So now, what is my verdict about this strategy? So personally, I don't use this strategy. I don't like the strategy. It doesn't go with how I trade, because if there is volatility or if the view goes against you, then managing this strategy is really hard, and the probability of making a profit is quite low, which I don't like in this strategy. So I personally rarely trade this strategy, and I don't like this kind of strategy, but there are strategies which I had in the coming days which I tell you that I am using these strategies, but this is one of those strategies which I don't use. But a lot of people in the market are using these strategies, but they're making money only because they have some strict rules and they follow those rules. And those rules are to be followed, and I've shown you what those rules need to be. Your rules should be like this, and if you follow these rules, then there is a probability that you will end up making money. So if you like this strategy, do hit the like button. And if you like these rules, do hit the like button, and also subscribe to the channel. See you in the upcoming videos. Thank you.